Good morning. Welcome to Stock Market Today for Tuesday. It's July 21st, 2020. This is your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where we get a lot of the content for this show. It also has daily stock ideas in there for you to consider. It hits your inbox every trading day before the market opens. So U.S. equities were mostly higher yesterday, following a third straight weekly gain for the Dow and S&P, with growth outperforming value after lagging last week. Remember, we started pointing out early last week that the trend was extended, and then we started looking at, remember Thursday, I showed you that growth screen of oversold growth stocks. The ebb and flow is still there. Our thesis very much remains intact that in a slowing growth world, you want to own growth. You don't go there in a straight line, obviously, but you'll get opportunities to add to the theme. Treasuries are stronger at the long end of the curve. The dollar was stronger against the yen, but weaker versus the euro and sterling. Gold was up 40 basis points, right? So another enduring theme of ours, while WTI crude was up a like amount. Your outperformers, consumer discretionary, tech, and comm services, sounds very much like growth leadership to me. Consumer discretionary obviously being carried higher by a nearly 8% rise in Amazon. Your underperformers, energy, utilities, industrials, REITs. Okay, fine. Our thesis on the market remains the same. S&P futures this morning, as we get to the desk, are up 70 basis points after Asian markets traded higher overnight, led by Australia and Hong Kong, both up over 2%. European markets are seeing a broad rally after the EU passed an economic stimulus package after a long weekend of debate and back and forth. Big stimulus package, but over $2 trillion in all. Treasuries are unchanged to a bit weaker at the short end of the curve. The dollar is stronger against the yen and the euro, but lagging sterling. Gold up 60 basis points. WTI crude up nearly 3%. And we looked at the chart. Remember the chart of oil. It's kind of at a key inflection point. So for the structure of the S&P 500, with all of that taking place, we can finally say we broke the resistance zone, right? We broke it by a point, 1.84 to be exact, but that's technically a break, if you will, right? You obviously want to filter it and pay attention to what's going on there. But I've been waiting to write finally with an exclamation point, and now we can. SPX breaks the resistance zone. You can see the top side break here. Down below 3,000 to 3,100 remains support. No change there. 2,850 to 2,950 below that. Resistance, we move it up. Let's call it 3,300 to 3,400 for now, with 3,400 being the February highs, right? Within a few points of, right? The highs are in play if support holds. We are overbought with that divergence still there, right? So remember, divergences need to be confirmed, right? Divergence is, hey, wake up, look at this. Hey, wake up, pay attention. They do have to be confirmed. It would be confirmed with a breakdown. We're not seeing the breakdown yet. To me, you need to break below 3,150 here, this local low, to confirm this divergence. Chaikin money flow is bullish, and it's actually broken this small downtrend line as well. So that's the structure of the market as we dive in. Growth over value, for the most part, large over small. I like treasuries. I like gold. What's amazing is through everything that we've been through in the past 16 months, that view has not changed. That's the view. Those are the trends, right? You can infer what those trends mean for the economy, right? To me, those trends point to the fact that the market, and if we think of the market as a group of asset classes, are in no way, shape, or form disconnected from the economy taken as a whole. They're not. It's not. Simply isn't, right? If you're just going to look at stocks and say they're disconnected, maybe, but drill down. Growth is slowing. Growth stocks are leading. Is that a disconnect? No. Massive amounts of stimulus added to the system, propping up commodity prices. Is that a disconnect? No. Just follow the trends. The narrative will get you in trouble. More often than not, I get myself into trouble in my personal trading when every now and then I go for the narrative and say, well, this has gone too far, too fast in light of this narrative, and I get more defensive than I should. That's when I get in trouble. Just follow the trends. And then I have to back it off and say, all right, just get back to trend, Dan. Just get back to trend. Let's talk about our market in a minute. The Qs are up more than 2% to a new closing high. Europe passes a massive stimulus bill. We're going to take a look at a chart of VGK a little bit later on. Healthcare holding relative support as financials break down further following earnings reports, and futures, as I said, point to a higher open today. We're going to go a little bit quickly here because I kind of got getting a little behind on time. But I think it's important, right, to hammer home the importance of the trends. You can be aware of the narrative, right? But the trends are what matter. And then your risk management will get you out if the quote unquote narrative proves true. Dow flat yesterday, 7-7 bulls to bears. S&P up 80 basis points, 135 to 83 bulls to bears there. Actually a slight downtick in that ratio, kind of interesting. NASDAQ big outperformer, 42 to 8 bulls to bears. Small caps down on the day. It kind of felt like we just got back to normalcy, really. 579 to 287. Bonds uptick, tech, big outperformer, along with discretionary due to Amazon. Our stock of the day, I like gold, right? I've been bullish gold. I like gold. I like gold miners. I like silver. I like silver miners. Newmont is actually the stock that we are featuring in my market survival guide, which is our bigger picture strategy note that comes out once a week on Tuesdays. Bullish rating, strong trend, strong industry group for this stock that is still outperforming. Now, it's had a little blip in the relative strength, but it's still holding. It's oversold. Bullish money flow as it tested and held the rising long-term trend line with solid price-based support around the $60 level, right? I think that Newmont makes a ton of sense. This is a nice setup here, right? If you're a trend pattern trader, you have a triangle consolidation from which the stock is now breaking topside, making a compelling entry. Take a look at Newmont as a bullish idea. Let's look at our sector tracker now. Moving to the major sectors over the last 5 days, starting to see the rotation back. Remember yesterday, tech was at the bottom. Now it's at the top past 5 days. Materials, our favorite of the cyclical sectors, right? If I think about the cyclical sectors as financials, materials, industrials, and energy, my favorite of those four, materials, I want no part of energy. I want no part of financials. Okay. Industrials, I might be willing to drill down on different industry groups, but materials to me are the best bet in that group based on our work. You could see it in my relative strength work in today's note if you get my note as a Chaikin Analytics client or if you're taking the trial. Discretionary comms, utilities, middle of the road, energy, staples, fins, and REITs, bottom of the list. REITs really falling out of bed on a relative basis. All groups higher over the last 5 days of trading. So if you're bullish, that's great. But where do you want to be? How do you want to be positioned? If you want to just own SPY, that's fine too, perfectly viable. But if you're just owning SPY, there's probably not a lot of need for you to be spending time doing a ton of research, right? You've just established that you want to own US equities, you'll own SPY. If you want to drill down, if you want to try to beat the market, if you want to try to skirt to the outperformance, today's note and every Tuesday's note is a must read. Relative strength. Let's look at our industry in focus, regional bank services, which I hate. And I have hated. It's kind of like energy for me. It's going to take a lot to get me excited. And we're just not there yet. Even when we see these counter trend rallies, right? Our model doesn't change. The ratios don't change. I don't see compelling opportunities. Regional bank services have lagged the S&P 500 by 32% over the past 6 months. 39-7 bears to bull on the power bar ratio, ranks at 20 of 21 subsectors, down towards the bottom of the list. Commerce Bank, Community Bank, and United Bank, all with very bearish Chaikin power gauge ratings as holdings of a fund that looks like that. Does that look like the S&P? Does that look like tech? Does that look like healthcare? Does that look like anything you want to own? Bearish fund, weak trend below the declining long-term trend line. Bearish money flow overbought, underperforming. If this was a stock, I would say it's a great setup as a bearish idea. To be perfectly frank, its sister fund, KBE, the large cap bank index, I'm long put options. And if there's liquidity there, I'm going to do some work to see if there's an opportunity in this because I like this setup. I like this setup. Playing for maybe a premature breakdown from that triangle consolidation. Let's take a look at what's trending now. Yesterday's S&P 500 movers and shakers, our gainers and losers. Amazon up 8%, nothing company specific, but think about Amazon with its market cap adding 8% in a day. Pent up demand for these growth stocks. Citrix, part of the software group, their report on Thursday up 7.5%. ServiceNow, NOW up 6.5%. Software had a big day yesterday. Noble being bought up 5.4% as the weak have to consolidate within the energy space. INCY didn't see anything company specific there to drive that stock higher by about 5.5%. Peak down 5.25%. No real news there. SL Green, REITs are just a disaster. And SL Green caught a downgrade from Deutsche Bank yesterday to take 5% out of that stock. VTR added to the group of REITs, a disaster. United Airlines, nothing company specific. They do report earnings this week, I believe today, down 4.7%. HWM, didn't see anything company specific on that stock, which is not rated, to take 4.7% out of it. So it's relative strength day. I think arguably this is one of the most important notes I write. I mean, I should sit here and say I love all my children equally, but I don't, at least not on my notes. This is one of my favorite notes to write because the sector rotation is where the opportunities lie. If you think about what is the market doing, and within the market, what's leading, what's lagging, and how does that then lead to opportunities? Healthcare is a broad group, but as a sector, when it was consolidating up here, we turned cautious on it, and then it broke down on a relative basis. And then last week we started pointing out that it was testing support, and now we've held support. Notice we didn't become oversold on the ratio. On an absolute basis, XLV is breaking topside to new highs. So what I see here is a relative hold of support, an absolute topside breakout. The ratio, the relative relationship couldn't even become oversold on this downtrend, right? We actually have a small positive divergence in play. So I want to start looking for healthcare. I want to start drilling down on the healthcare sector. And I want to see where is the strength within the sector, right? We know it's in biotech. We know it's in devices. Pharma's been a little mixed. Services look interesting to me. I actually highlight them in my note today. But that's why this is my favorite note. So if I'm thinking about where do I want to look for ideas, I want to look for ideas in the healthcare space as opposed to here, the financials, where banks were not a catalyst, it would appear. Take a look at that chart, XLF relative to the SPY. That's a clear downtrend. That's a clear downtrend that looks like it wants to test recent lows. That's below the 200-day moving average, which is declining. The RSI could not become overbought on a rally attempt and is now moving back towards bearish ranges after breaking the uptrend line. Now, on an absolute basis, we have not completely broken down yet, but I think odds favor a breakdown. Right, so again, think about what's going on here when you want to say that the market's disconnected from the economy. Huge debt loads in a slowing growth environment. The banks all came out and told us that they were increasing their reserves for loan losses. And you have the financials massively underperforming and on the verge of a potential breakdown. So is the market disconnected from the economy? It really depends on your definition of the market. I don't think it is, and I never have. Watch Europe on the heels of stimulus. Passed the big stimulus bill last night. Take a look at the VGK breaking topside, similar to the S&P 500, closer to overbought. But what's interesting to me is we are on the verge of a relative break of this trend line, which would be interesting because the U.S. has been the best game in town for a long time. I'm starting to pay attention outside of the U.S. That'll wrap us for today. 14-day trial, chaikinanalytics.com/test drive.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.